Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, index funds present an attractive option to investors looking to strike a balance between low risk and good returns. So, in today's episode, let's learn from Dhirendra Kumar how to effectively harness the potential of index funds to build a robust portfolio. Welcome, Dhirendra.
Thank you.
So let's start today's discussion with delving into the reasons behind the popularity that index funds have been gaining of late.
One is that simplicity. It's very easy to understand. Here is an index. This is how it is constructed. And if you invest in this fund, it will be taken care of. The normal mutual fund arena is very complicated, but wide variety of funds and many things to choose from. Of course, index category is also getting complicated, but by and large, it is easy to understand. Second is the cost. The asset management that you get here is at such a low cost. And third is that the rising popularity in India is not in terms of investors are queuing up to invest in these funds.
Right.
Just because mutual fund companies are creating a wide variety, large number of different kind of index funds, that we see that there is greater noise or around them. But we have seen the big money flowing into mutual fund, into index fund entirely because the employee provident fund money, once it was mandated by the government that EPFO should invest money in equity, the chosen vehicle was index fund. That is why we see the money. Index fund or active fund, one should not forget the basic rule that you should be investing for the long run. You should be investing, being index fund, they are not insulated from all the wild character of the market. They will go up and down. So do your SIP. Keep it simple. You can do it at different levels. But your long-term money and doing periodic investment and making sure that you don't panic at the worst of times is still important.
Now, moving on, how to use index funds to build a robust portfolio?
To begin with, you should keep it very simple. As I say that, invest in a aggressive hybrid fund. So put 25% money in a debt fund and 75% into a Nifty or a Sensex fund. That is it. It will keep it very simple. It will be very low cost, very easy to understand, and you can be at it for next, the initial 3 to 5 years. And you will get 90% of the benefit, maybe more, because if more and more funds are struggling to beat the index. Second is that, making it a little more sophisticated, getting a full market exposure. And there are multiple ways of going about it. Ideally, one should have, 50 to 70% into large cap, 20 to 40%, depending on your own tolerance, into mid cap, and 10, 20%, 30% into small cap. So you decide on your allocation and choose one index fund. And of your 100 rupees, 50 into Nifty,
Cap.
50 into Nifty or Sensex, 30 into any other, mid cap index, and
The
remaining into small cap index. And here you have all cap index, which you don't have to worry about. And there will be churn within the portfolio because these though index investing is being referred as passive investing, but index constituents change.
Right.
And when index constituents change, your portfolio will change.
Right.
Though you will continue to hold BSE small cap 250 index or NSE 250, but 50 of the companies within that would have undergone a change you may not notice. So you are getting a first class portfolio. Then if you want to make it even more sophisticated, then you can add a international fund to it. A Nasdaq 100 index is available, or a fund of fund is available mounted on that index, or you have a FANG Plus index available, or you have a Hang Seng index available. If you want to keep it a very low maintenance portfolio, then you can well go for a completely different vehicle of an index, which is, there is an index available, which is not a very popular index, but a total market exposure index. It is, most of our index or the large index or the popular index, they tend to be large cap heavy. Yeah. This is a fund, this is an index where there is a substantial exposure to all the sectors, or reasonable, well-spread, diversified exposure to all the sectors and all the segments of the market. If you want to really uncomplicate your investment journey and you are unable to decide on which fund, but you know that this is the money which you are unlikely to need for 5-10 years, invest in the largest index fund. That is it. And keep investing month after month.
All right, now we come to the question of, with so many index fund options available out there, how should one choose the best suited for them?
There isn't much of a difference. If you choose Sensex or Nifty, it doesn't make a difference. It certainly doesn't make a difference over a 10-15 year period. And even if it does make a difference of few basis point or 1 or 2 percentage point, it can't be anticipated. You can't do much about it. So don't bother, don't think too much about it. One is that there is a variable. There are variables based on which you should make a choice. Look at our website or look at our Mutual Fund Insight magazine. There is an index fund scorecard and 2 variables. One is the cost. Cost is paramount. Everything else being equal, low cost fund will give you better returns.
Right.
And these costs are so compelling, so attractive. Sometimes you're getting this Nifty index fund at 0.05%. It's almost free. Likewise, so look at cost, look at the expense ratio. And the second is the tracking error.
Right.
I would like that once I have chosen an index fund, then that index fund better replicates the index to the best of its ability,
Right.
or to the extent possible. So choose the tracking error, choose the fund which has the lowest tracking error. So combination of expense and tracking error from our index fund scorecard.
All right, then, before we end today's episode, we have a viewer's question that we would like to answer. Vinod asks, for long term, say for 15 years, is it okay to go for a small cap fund?
It is okay to go for a small cap fund. But the problem is that it is not okay for a new investor. Because anybody who has come to the market in the last 3, 4 years, 5 years, he would have seen only the upside of the small cap. But you should not forget that in 2008, the small caps fell freely. They fell by 58%. So it is not meant for everybody. But over the long run, if you are carrying a diversified small cap portfolio, you will be a winner. Look at the small cap fund universe. Over the last 10 years, it has given a return of 23%, which is the highest among the diversified vehicles. Then look at the last 20-year performance. The small cap total return index is the best performing index over the last 20 years. Even if you look at last 5 years, it is the best performing fund with nearly 25%. And that is true for the index as well as the actively managed fund. So of course, these are the good times for the small cap. There is a euphoria around small cap, and euphoria will not continue forever. There will be bad times as well. But
if you withstand those
if you can
bad
withstand, and if you can actually withstand those periods, continue investing, these returns could even be higher.
All right, then, hope, Vinod, you've got your answer. So keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.